Hey guys, what is going on? Welcome back to my Robinhood portfolio. Today I thought I'd talk about what an investor should do when the stock market is pulling back. That is, stocks are decreasing in value, and as a result, individual portfolios are also losing money, and investors are essentially having negative returns. As you guys know, I put out a couple videos talking about my portfolio, talking about the fact I've lost quite a bit of money over a short amount of time, both because the stock market has been trending down, but also individual stocks have been trending down as well. If we take a look at some of my ETFs here, these are great reflections of what the overall S&P 500, what the overall stock market is doing. If we take a look at a great graph here from VYM, this is a great index fund, really gives you a sense of what the overall market is doing. You can see it's down 1.18%. Another S&P 500 index fund, SPHD, down 1.58%. SDY down 1.68%, SCHD down 0.77%, and DVY here down 1.41%. So you can see here the market as a whole in general is pulling back. And then also individual stocks, Portola, one of my largest holdings, you can see over the past week down 9.7%. Did not have a great earnings report over the last one quarter, and Ford as well. Over the last one day, it had an okay return. I think it was 0.19% with after-hours trading. But over the last week, it's down 1.37%. So my largest holdings are decreasing in value. The stock market as a whole is decreasing in value. In this type of situation, what should an investor do? So there's been a lot of opinion on the channel. One end of a spectrum, viewers have been saying, put more money into the portfolio, keep the stocks you have, but put more money into your positions, buying at a discount. At the other end of the spectrum, a little bit riskier play is simply selling off the entire portfolio. So it doesn't matter if you are net positive for a particular stock. It doesn't matter how negative you are for a particular stock. You'd sell off at a loss, sell off all your stocks, hold all of that portfolio value as cash, and then when the stock market continues to trend down, you try to jump in at its nadir when it's at its absolute lowest, with the idea that when the stock market does rebound, you'll have a much, much greater return than if you were simply holding your portfolio and adding to your positions at a discount. That's very, very risky. So I thought I'd kind of touch on both of those, as well as a strategy that I have opted to do, which I have talked about in a couple of prior videos. So adding to positions, I definitely think is appropriate. When stocks are trending down, I think adding to value stocks that you think are going to be great long-term buy and holds is the perfect situation to do. Basically, dollar cost and value cost averaging. I've talked about this quite a few videos. When the price of stocks are decreasing, you simply put in a little bit more money than you would on a normal basis. So you put money in at a very regular basis, but when the stock is trending down, you put in a little bit more money. When the stock is trending up, you put in a little bit less money. And over time, that's really going to maximize your rate of return. So I definitely like that strategy. On the other side of the coin, selling off the entire portfolio, even if you're selling off individual positions at a loss, I don't think that's a great idea. And I'll tell you why. I've talked about this in a few videos as well. Trying to time the market is very, very risky. And you can't really do that on a consistent basis. So yes, you could sell off the entire portfolio, knowing that you're probably going to be selling off some of your individual positions at a loss, with the hope of buying back at an even cheaper price. So then when the market does rebound, you have a much, much greater return, even a greater return taking into consideration those losses. But it's really difficult trying to time that particular nadir, trying to time when it's at its absolute lowest in the market. If you miss that at all and the stocks start trending back up, you can't put your money back into the market. You might have to put your money back in the market at a more expensive price, but you've already lost when you sold off your stocks at a loss, trying to get out of the market and trying to time the market. So I don't think timing the market is a great way to go. I definitely don't advocate that. I'm not going to be doing that in my portfolio. What I have elected to do is kind of a hybrid scenario based off putting more money into the portfolio and doing dollar and value cost averaging. So before the market started trending back, I didn't think it was going to trend back this quickly, mind you. I thought it was going to trend back maybe in a couple months. I was going to hold a certain percentage of my portfolio as cash. So I'd get out of my day and swing trades at a profit. I definitely wouldn't be selling at a loss. So get out at a profit, hold that money as cash, and then when the market does trend back, then I'll jump into my positions when they become very, very cheap. That's kind of what I elected to do. I just kind of got lucky that I did that before the market started trending back. So I definitely am on board with the scenario in which you put more money into the portfolio. So I'm definitely going to be trying to mobilize some more cash, put into the portfolio, Probably will do that over the next week, but I'll do it in a dollar and value cost averaging way. So I'm not going to try to time the market at its absolute lowest and then throw in all my money. I'm going to simply be putting in money as the stocks trend back. The stocks that I'm going to be holding for the long term, as they trend down, I'm going to be putting more money into those stocks. So I'm essentially going to be buying those at a discount. And the more they trend down, the more of those particular shares I'm going to buy. So Portola, for example, the more this trends down, the more I'm going to buy with the hopes that it will rebound at some later date in the future. But again, you only want to do these for stocks that you have in a buy and hold strategy. If you're trying to do some day trades, some swing trades, penny stocks, this is not the particular method to be using with that regard. This is only for stocks that you're more than comfortable holding for 2 years, 5 years, 10 years down the road. It's value cost and dollar cost averaging over the long term for buy and hold stocks. So that's what I'm going to be doing with the portfolio. I'm going to be mobilizing cash, putting it in the portfolio. All of those day and swing trades that I got out of that I'm holding as cash. I'm also going to be doing dollar and value cost averaging into my good long-term buy and hold. So those are stocks like Pfizer here, for example, PFE, a great buy and hold stock, Abbott Laboratories, Cardinal Health, J&J. Down the list here, I like Ford long-term. I know a lot of investors do not like Ford, but Warren Buffett has a great saying for the type of investing I like to do. Be fearful when others are greedy, and be greedy when others are fearful. So there are a lot of investors fearful about the U.S. automotive industry, about U.S. stocks in general, and consumer discretionary. Ford, they're very, very wary about, very, very fearful. So I'm going to be buying into the stock. It's at a discount. You know, it's been having record profits, $10 billion profits. You know, we're talking about billions of dollars in the green. And yet the price of the stock has been trending down 7.29% over the last year. And over the last 5 years, it's only up 42.69%. It's actually been decreasing in value, even though it's been performing very, very well. Record profits. And yes, I know, I understand that in the future, it's not going to be sustaining that kind of performance, but the entire industry won't be sustaining that type of performance. And over the long haul, it's going to have its ups and downs. And the automotive industry is, and basically in a cycle, it's going to be on the up cycle at some point in the future. And when that happens, I think there's going to be a very, very good return on money with Ford. Again, be greedy when others are fearful. Be fearful when others are greedy. And on the other side of that coin is Apple, for example, or technology in general. A lot of money has been put into these technology stocks. You can see over the last year, Apple is up 48.63% over 1 year. So there are a lot of greedy investors right now with Apple. So I'm going to be fearful with Apple. I just don't think that's going to be sustained. Over the last 5 years, it's only up 95.64%, but over the last year, it's up 48.63%. So I think that's unsustainable. AMD is another great example. Over the last 1 year, 85.76%. And I understand it has a lot of good products coming out. It's very competitive with Intel right now. Cryptocurrency has definitely made sales of their particular products increase quite dramatically, but over the long term, I don't think that's going to be sustained. You can see here Intel, 7.11%, but AMD is up 80-some%. Don't think that's sustainable. I think this is probably going to come back at some point. So be fearful when others are greedy, and be greedy when others are fearful. That's kind of my mindset. I'm also a contrarian investment type of investor. So GE is another great stock. Let's just kind of scroll back up to that. And I don't want to make this video too long here, but this has been trending down 16.5% over the past year. But you can see this is a very good company. $218 billion market cap company, a very, very large company. PE ratio 28.98. Good dividend yield, which has been sustained. Dividend aristocrat, great stock. I think I'm going to be putting money into GE as well. So again, I'm going to be putting money into the portfolio. I'm not going to be selling off the portfolio, trying to do market timing. I'm going to be putting money into contrarian investments like Ford. I'm going to be fearful when others are greedy, aka Apple. I'm going to be greedy when others are fearful, aka Ford. But that's my perspective. It doesn't mean it's right or wrong. There's lots of different ways to play the market. Please let me know what you guys are doing with your portfolios. If you are of a similar mindset as myself, or you guys have a completely different way of playing the market, always interested to hear what you guys are doing with your portfolios, because as you guys know, this is a learning portfolio. The whole point of this whole video series is to learn about investing for myself, for viewers, and if you guys have any great questions, anything you want to read up about, anything that you are not quite sure about, please let me know. I'm always looking for new video ideas and always looking for new topics to read up about. So if there's any questions about anything, please let me know and I'll do a video if there's enough interest. So kind of with that, I'll end the video. As always, if you guys enjoy my videos, feel free to like, share, and subscribe. Until next video, we'll see you then.